Welcome back to Investing Talk Podcast.
Today we're looking at AST SpaceMobile.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you're looking at a company like AST SpaceMobile, you really have to start with the core thesis. Because everything else, the debt, the volatility, all the heavy spending, it all comes back to the strength of their competitive advantage, their moat.
And the moat here isn't just some incremental improvement. It's a radical shift.
Exactly. We've all heard about satellite internet.
Right.
But the key difference here, the thing that changes the game, is that they enable 4G and 5G broadband directly to unmodified smartphones.
To the phone that's already in your pocket. No special dish, no clunky add-on.
That is the technological breakthrough. It solves the biggest problem in satellite communications, which has always been the power issue.
The power issue.
Yeah, normally a satellite in low Earth orbit needs you to have a dedicated terminal on the ground. Your phone just can't shout loud enough to reach space. AST SpaceMobile completely flips that whole equation around.
Okay, but how, for those of us who aren't satellite engineers, how do they get around that fundamental physics problem?
It really comes down to two big proprietary pieces. First is the sheer size of their antennas in orbit, just massive.
Right.
And second is the IP, the intellectual property that's baked into their specialized chip, the AST 5000. They've basically designed the satellite itself to solve for the power constraints of your phone.
So they're using a huge, powerful amplifier in space to make up for the tiny little antenna in my pocket.
You got it. They're putting the cell tower in the sky and making it gigantic.
And when you say gigantic, you're talking about these Bluebird satellites, right? Like the Bluebird Sim.
Phased arrays on those are just staggering. We're talking up to 2,400 square feet.
Wait, 2,400 square feet?
To put that in perspective, that's about the size of a tennis court.
A tennis court?
Or a really big 4-bedroom house, all folded up, packed onto a rocket, and shot into orbit. It's the largest commercial communications array ever deployed in LEO.
Wow.
And critically, it gives them a massive capacity boost, a 10 times improvement over their older test models.
And that sheer physical scale, that's the core of the moat, like you said. If you have an asset that enormous in orbit, you don't need all the specialized gear on the ground.
Precisely. And that superior capacity and coverage, well, that translates directly into a huge market.
A huge market is an understatement.
We are talking about a total addressable market, a TAM, of around $200 billion in mobile broadband.
$200 billion.
Yeah, and that's mainly focused on those underserved markets, places where cell coverage is just patchy or non-existent.
And to capture that market, you need access. This is where the partnerships come in, right? They've already got deals with over 50 mobile operators.
Including huge strategic partners like AT&T.
That's the commercial strategy right there.
It is. They don't have to go out and acquire millions of individual customers one by one. They just sell access to the mobile network's existing customer bases.
It creates instant scale once the network is actually running.
Okay, so that's the bull case. Groundbreaking tech, huge market. But we have to pivot here because the tech alone doesn't pay the bills.
And this is where it gets tricky.
When you shift from the engineering to the financials, you see exactly why this stock is so volatile. The company is, it's fundamentally pre-revenue, at least in its commercial phase.
That's the critical tension point for anyone looking at this.
Yeah.
They are in the middle of this massive capital-intensive deployment.
Which means they are burning through cash at an incredible rate.
Free cash flow is deeply negative.
Of course, it has to be. The CapEx, the R&D to get this network flying, it's all upfront costs.
And we saw the market's reaction to that with the Q3 2025 results. They were called disappointing.
But you have to have context, right?
Right.
This is what an early-stage, high-growth deployment company looks like. They aren't trying to be profitable today. They're trying to build a generational asset that they hope will generate billions in revenue years from now.
So if they weren't spending aggressively right now, that would almost be a bigger red flag.
Exactly.
But funding that build-out, getting those, 45 to 60 satellites up by the end of 2026, that takes a staggering amount of capital.
Which brings us to their financing strategy. It's been just as aggressive.
The balance sheet shows some serious debt. The big one is that $850 million convertible senior notes offering.
Yeah, the one due in 2036. And it's important for people to understand what that is.
It's basically debt that can turn into stock later on.
Right. Usually if the stock price goes way up.
So they get lower interest payments now, But the market knows that if the company succeeds, all that debt will convert into new shares.
Meaning the current shareholders get diluted. A lot. It's basically a deferred equity offering that's paid for by future growth.
And that's why the stock dropped, what, over 7% right after that was announced.
It was the market pricing in the future cost of success.
But management has been clear. They see these moves as just necessary steps.
They're prioritizing getting the network built over any kind of short-term shareholder return. No dividends, no buybacks.
They are playing the long game.
Yeah.
And to be fair, they are managing some existing debt, right? I saw they did a $50 million note repurchase.
They did. It reduces their interest expense by about $13.5 million over the life of the note. So they're paying attention to the cost of capital even while they're raising huge sums.
Which leads us right to the catalysts. Because at this point, the only thing that justifies all that debt is execution.
Execution is everything now. We have to see that clear path to commercialization, the one that's supposed to outweigh all these financial risks.
And the biggest recent win on that front, the one that really de-risked the tech side, was that successful launch of Bluebird 6.
That was huge. December 23rd, 2025 from India.
That one launch was just vital. It was the final operational test.
It proved they can not only build, but successfully deploy and operate that massive tennis court-sized array in space.
The hardware works at scale.
Foundational step. Now you can actually start thinking about activating D2D service globally.
And now they have to move from that one success to, well, an aggressive scaling plan.
Incredibly ambitious. The forward guidance is targeting 45 to 60 satellite deployments by the end of 2026. That is the metric to watch.
That's the whole ballgame.
If they can hit that cadence, and then that's a big if, that's what creates the inflection point for revenue.
Because you need that density of satellites in orbit to provide continuous service.
Right. That 45 to 60 number, that's the tipping point.
And they're backing it up with manufacturing infrastructure. They've got, what, a 500,000 square foot facility now?
You can't build a constellation like this in a garage. Those facilities are absolutely essential if they're going to hit that 1 to 2 month launch cadence they're aiming for.
So, if they pull all this off, what's the ultimate payoff? What are the projections that make all this debt and risk worthwhile?
The company is targeting $500 million in revenue.
$500 million.
And 10 million subscribers by 2028.
10 million subs.
That's the long-term thesis in 2 numbers. And it all depends on hitting that constellation density by late 2026.
So let's talk about market sentiment, because it really feels like a tug of war right now. High anticipation, but also a lot of fear.
It's definitely mixed. You see this euphoria after a successful launch announcement, but then it's immediately followed by skepticism when a debt offering comes out.
It's a classic high-growth volatility pattern.
But if you look at the technicals, some analysts are pointing to, constructive patterns, accumulation phases.
Meaning long-term investors are buying up shares on these dips.
They're buying when there's fear about dilution.
We're also seeing some technical signals. I've heard talk about a potential golden cross.
For anyone tracking momentum, a golden cross is when a short-term moving average, like the 50-day, crosses above the long-term 200-day.
It's a strong technical sign that momentum is shifting to the upside.
Yeah, it suggests that belief in the long-term story is starting to overpower the short-term noise from the financials.
And we have seen concrete signs of confidence from insiders.
That's right. The director, Keith R. Larson, bought about $49,000 worth of shares back in December.
It's not a huge amount, but that kind of cluster buying from insiders, especially after a volatile period, it signals that the people closest to the plan believe the stock is undervalued.
They're putting their own money where their roadmap is.
So looking ahead, the calendar is all about execution, not earnings.
Exactly. The Q4 2025 earnings report in early February. Nobody is looking for a revenue beat. It's all about updates on the launches and the constellation progress.
The market just wants proof that they're on track for that 45 to 60 satellite target.
The next 3 to 6 months are about one thing: consistency. We need to see them prepping Bluebird 7 and beyond every 1 to 2 months, starting right now in Q1 2026.
If that cadence slips, the whole 2028 projection gets pushed out.
And the macro environment is actually starting to become a tailwind.
We're seeing some sector rotation back into space tech and other high-growth areas, especially now that interest rates are stabilizing a bit.
And of course, you have the rumors.
Always rumors.
One of the persistent ones is potential M&A interest from a big telco.
If they can de-risk the deployment. They become a very attractive target for a giant that wants to leapfrog into the space race.
And there are also quieter rumors about regulatory wins specifically tied to that AT&T integration. Getting that final spectrum access would be a huge, if boring, piece of news.
Okay, let's put it all together. The final investment thesis. What's the bottom line for someone listening?
The bull case is all about that proprietary DTD mode. Bluebird's looks prove the tech works. So now, the company is positioned for just explosive growth, if they can pull off the 2026 scale-up.
A very important if.
They've solved a massive technology problem that unlocks a $200 billion market,
Okay, but the bear case, the main challenge is purely execution risk.
above all else.
Can they really hit that cadence of 45 to 60 satellites? Can they manage the capex and the dilution from that huge debt offering without just crushing shareholder value in the short term?
And that's what creates all the volatility.
So the overall takeaway is this is a high-risk, high-reward, multi-year hold. No doubt about it.
Absolutely. You're betting on a transition. You're betting that this pre-revenue R&D company can transform into a fully commercial, scaled, and profitable network in the next 18 months.
Success or failure hinges entirely on their ability to stick to that relentless launch schedule.
It's the ultimate space race manufacturing bet. The tech is proven. The real test is turning that marvel into a factory line that can pump out tennis courts into the sky every few weeks.
A fascinating high-stakes story to watch. If they succeed, the disruption is enormous. If they stumble on that cadence, the financial consequences could be severe. That's what you need to be tracking.
A great breakdown.
If you found this discussion valuable, make sure you hit that subscription button so you don't miss our next analysis. We'll see you next time.